Deal or not, the chances are that America is probably heading for a downgrade from the ratings agencies, that treasured AAA gone. The question the markets are wrestling with, ours included, is how that will shake out, given the US dollar remains, for now at least, the world's reserve currency. Here's Andrew Robertson.
US government bonds have been rated AAA for the last 70 years. With the US debt ceiling set to be raised to $16.5 trillion, that AAA rating is looking increasingly unsustainable.
I think it's inevitable. I think from what the ratings agencies have said they look at, and one of those is obviously the ability to pay on time and the full amount, that they will have to downgrade.
But according to University of New South Wales economist Nigel Stapledon, a downgrade won't be the shock to the global financial system that many people are predicting.
All these events aren't new. They've been going on for a while, so investors aren't going to sit back and wait till the credit rating agencies to decide what they think of it. They form a view, and it's reflected in the market already.
A view the Grattan Institute's Saul Eslake agrees with, but he adds that if there was an adverse stock market reaction to a US credit downgrade, there'd be an impact on Australian superannuation funds.
Lower share prices in the United States would probably be echoed in other parts of the world, including Australia, so the vast majority of working Australians who have superannuation funds would see some effect there.
Whatever the market response, a lower US credit rating means the US government will have to pay a higher interest rate to entice people to take on the perceived higher risk of lending to it. And that's also where it will start to be felt in Australia.
A lower credit rating for the US government, you've got a very strong credit rating for the Australian government and a much lower debt situation here anyway. That means that we become much more attractive as a market.
Increased demand for Australian government bonds will drive up demand for Australian dollars to pay for them, which will send the already skyrocketing Australian dollar even higher. As a result, those industries which have been doing well out of the Aussie dollar over the last couple of years will do even better, and those which are struggling will find life even tougher. Much tougher, according to the Grattan Institute's Saul Eslake, who can see a US credit downgrade adding up to 5 cents to the dollar.
It may be that the Australian dollar rises disproportionately because investors who sell US government bonds in reaction to a downgrading of the US credit rating might think that some European countries couldn't be far behind, and therefore there wouldn't be any point in putting money there, or in Japan, which has had a couple of downgradings of its credit rating already.
And that would be very bad news for manufacturing and domestic tourism, which are already struggling, while online overseas shopping will become an even bigger threat to local bricks and mortar retailers. On the other side, imported goods will become even cheaper, as will overseas travel, which will help companies like Qantas. And getting a loan from a bank might become easier. That's because Australia's banks could find themselves flush with money. They raise about half their funds on overseas financial markets, which since the global financial crisis has not been easy. However, if the US is officially declared to be more risky, big investors will be more likely to lend their money to Australian banks instead.
Those extra funds mean that the banks have the capital to be able to lend to others, whether it's an individual or a business.
In the meantime, the world is waiting for the credit rating agencies to make up their minds.